Welcome, everybody, to another episode of Smart Money Circle. My name is Adam Sarhan. With me today is John Guerard, Ph.D. and Director of Quantitative Research at Mckinley Capital with over $4 billion in assets under management. John, welcome to the show.
Thank you very much. It's a pleasure to be with you.
So, John, I always like to ask, how did you get involved in the business? And if you can give us some background about your story, we'd greatly appreciate it.
Certainly. I became interested in asset management in the mid-1980s when I was doing research. I was teaching at Lehigh University at the time, and I was doing research for the Q Group, the Institute for Quantitative Research and Finance, and we were doing work on earnings forecasting. And one thing led to another, and pretty soon I was doing research, and one of my students' fathers invited me to join a firm in Chicago, and I left the university in 1987, right in June of 1987, right before the little flash crash type of event. And I've been on Wall Street for over 30 years. It's been a pleasure. I have seen a lot of ups and I've seen a lot of downs. The best thing that ever happened to me when I was working at Drexel Burnham Lambert was my firm went bankrupt. And the reason I say that is because it led me into an association of over 30 years with Harry Markowitz, whom I joined at Daiwa Securities and who serves on our scientific advisory board.
Oh, very nice. So how did you meet Harry? Was it just a coincidence, or did you guys have something in common, or had the paths crossed?
When I was at Drexel Burnham Lambert, one of my responsibilities was to help bring in academics for a research seminar that we ran in La Quinta.
Okay.
Right outside of Palm Springs. Now, to be very honest with you, when you're running a research seminar at La Quinta and you call an academic who lives in New York or Chicago and you say, gentlemen, ladies and gentlemen, we're having a research seminar in La Quinta where it's 85 degrees in February.
Yeah, no humidity.
Would you like to come and speak?
Right.
Usually we would get people that would come at the drop of a hat. Oh, yes. I have a paper right here, and I'm ready to give it in 15 minutes. I called Harry Markowitz for 3 straight years and was turned down.
Oh, wow.
Because he had a class on Thursday and could not accommodate our schedule. But I met Harry in that way, and I got to know him before Drexel melted down, and so that's why it was a relatively easier connection with Harry at that time.
Oh, very nice. So, John, can you tell us a little about your investment strategy, please?
We are a global growth specialist, and what that means is we are primarily a quant shop. Okay. That means that we are a firm that's 80% to 85% quant. We have portfolio managers. Our investment style is that while we are a quant firm, we primarily focus on forecasted earnings acceleration, buying stocks that will appreciate faster than the market because their earnings will exceed analyst expectations, and we combine that with a price momentum strategy where we want to buy stocks, where obviously the trend is your friend. So what we're hoping to do is to be able to buy stocks that have good forecasted earnings acceleration, good price momentum. We like to maintain as low a standard deviation as possible, and those 3 factors guide us in the way of our stock selection. We have a stock selection model, and we are big on Markowitz mean variance efficient frontier modeling.
Sure.
So we are a quant shop, and we do have portfolio managers.
Excellent. Can you explain that to the audience a little bit, just to dive a little deeper and educate them on some of those theories?
Certainly. When you're talking about buying stocks, and let me start at how I started working with Harry in 1991 and how our work has proceeded.
Sure.
In 1991, people were doing lots of work on fundamentals. At that time, Laconishok at Illinois was doing some great work. Jacobson Levy were doing really good applied work, and they were using our Drexel Burnham Lambert database for their work at Jacobs Levy Equity Management. My friend Bill Ziemba from the University of British Columbia was doing work in Japan. He was on leave at that time, working on building U.S. and Japanese models. And when I left Wall Street, we started working on these projects. And what we were doing is looking at earnings data for historic earnings, historic book value, cash flow, and sales, how these variables moved relative to their means. And then we looked at the forecasted earnings. And we wanted to see where analyst forecasts incorporated into share prices. They tended to be. Were the revisions important? Oh, yes. And was the direction of the revisions referred to as breadth by Lang Wheeler, the guru of numeric, the founder and guru of numeric, were they incorporated in the share prices? And the answer is no. And so that's how we started our strategy in 1991. When I was with Harry, we had a blank slate, and we said, this is what we believe. We do believe in the low PE approach with Graham and Dodd, and we believe in fundamentals, and we believe in forecasted earnings work. And that's how we started. And we did acknowledge on many occasions that momentum worked, particularly in bubble economies. And that's how we started doing our modeling business.
I love it. So your earnings is that you look at a few factors. You just mentioned you look at the actual company earnings, you look at them with respect to analyst expectations, and then you look at revisions. Is that correct? Or did I miss
That's absolutely right.
Those are the three things. How about quarter over quarter over year actual earnings growth compared to where they were the prior year in the same quarter or the prior year period? Can you look at that?
Yes, we have.
Okay.
Yes, we have. Now, I'm going to tell you a lot of stories along the way, and if my stories bore you, you tell me, John, speed it up a little bit.
No, please, by all means. I love stories, and so does the audience.
When I was at Lehigh, I went into NYU and I taught in the summers at NYU for several years. And one of the people who has been most influential in my life and whom Harry Markowitz dearly loves is our good friend from Ridgewood, New Jersey, Marty Gruber and Ned Elton. And they have been the Nomura professors of finance at NYU for the better part of, well, they've both been at NYU for over 45 years. They're in the process of retiring now. But Elton and Gruber had written a great paper on earnings forecasting and revisions in 1981. And when I started doing my work for the Q Group, this paper greatly influenced us, and Marty Gruber continues to be a very good friend, and he and Harry and I always enjoy getting together, and we always talk about earnings revisions. We always talk about the breadth of those revisions, the agreement among analysts, and we do believe that there is a great propensity to be able to reap returns from analyst forecasts and the revisions.
So if you can help just explain, I guess educate more would be a better word to the audience.
Sure, absolutely.
Yeah.
Suppose I tell you that we have a stock. Well, we'll take a random stock like say IBM or Boeing or Dominion Resources, which is now Dominion Energy. And suppose I tell you that there is an earnings forecasting number for 1 year ahead and 2 year ahead, and we primarily work with annual data for the sake of conversation. Okay. And we look at earnings forecast. We look at the earnings forecast relative to its price, the 1 year ahead and 2 year ahead forecasted earnings yield. We look at the revisions, the monthly revisions on the 1 year and 2 year ahead forecast, and the directions of those revisions. In other words, the number of up minus the number of down divided by the total number for FY1 and FY2.
Okay.
Now,
FY being fiscal year, just so the audience knows. Okay, keep going.
Yes.
Yep.
So about 20 years ago, I was working, my paper with the Q Group was published, and what we were interested in showing was that analyst forecasts were not completely incorporated into the share prices on the basis of those 6 factors: the 1 year and 2 year ahead earnings breadth, the 1 year and 2 year ahead revisions, and the 1 year and 2 year ahead earnings forecasted yield. In other words, the forecasted yields were incorporated in the share prices Marty Gruber showed in their 1981 management science piece. However, the revisions were not. And the key was, if you could find the stocks, and this has always been true, if you can find the stocks that are going to report earnings that exceed expectations, then you are going to make money in 3/4 to 85% of the years. Between 75 and 85% of the years, you're going to outperform. And that outperformance, by the way, is greater in the global markets, particularly in the non-U.S. markets, than in the U.S. market.
Oh, wow, that's fascinating. So what you're saying basically is you want to find stocks that are able, the companies themselves are able to beat expectations fiscal year, 1 year out, 2 years out, and they do it for several quarters. And if they do that, you'll have very strong performance.
That is true about 80% of the years.
Wow. So in other words, when a stock gaps up after reporting earnings, that would be a good expectation or a good example, excuse me, of a stock beating expectations and raising guidance?
Well, yes, that's part of it. I have to tell you though, when I was in graduate school,
yeah,
I was very fortunate because I took classes from really smart people, and two professors that I just want to throw out their names. Jan Mawson, who was one of the three creators of the capital asset pricing model, taught me my doctoral seminars at Texas.
Oh wow.
And Mawson was a brilliant person, and he was always talking about market efficiency, and he was looking at all types of forms of the capital asset pricing model. Now, when I was in his class, Richard Roll was attacking the CAPM and saying, you can't identify a great market, so how can you expect to be able to estimate betas?
Right.
And Jan Mawson says, that Richard Roll is a smart young man. And he says he has identified a problem which we all acknowledge, although we have not acknowledged it as forthrightly as we are now. However, he had his orthogonal portfolio solutions. He says, however, his solution is probably not what I would put an X in the square of, so to speak, right. Kind of like Hollywood squares. Yeah. And so the thing about the Mawson taught us about the capital asset pricing model. Although Mawson also would also tell you, and you know what? I came up with the CAPM from his absolute dollar format, but I have never estimated a beta in my life.
Wow. So basically,
he says, I believe in theory. I don't believe in empirics. Now, the other person that taught me an awful lot, and this gets back to your earnings quarterly work. I took a portfolio theory class when I was at Duke from a gentleman named Henry Latney. Now, Henry Latney was brilliant. I took his class when he was, I think, 77 years old.
Oh, wow.
Henry taught till he was 82. We didn't call him Henry. He was Professor Latney. Henry Latney was the chaired professor at Chapel Hill. So on Thursday afternoons, I would drive over 7 miles.
Right.
Now, when you're a Duke undergraduate, you go over and take Henry's class. It's a real, very big step. And I was taking it then as a part-time graduate student the year I was taking Latney's class. Latney was brilliant. And of course, he came up with SUE, the standardized unexpected earnings. It was, of course, a quarterly model. And Latney was then publishing his work with Jones, who teaches at NC State. And Latney and Jones, and then Latney, Jones, and Randleman came up later with a more consistent framework having to do with the risk-return profiles. But, Latney was brilliant. And when I was in his class, he was always talking about quarterly earnings surprises. The SUE model that Latney brilliantly put together does not have quite the force it used to. It's been hedged out.
Understood.
The breadth factor has not been hedged out yet in terms of the earnings work that we do. Our earnings work has to do with revisions and breadth more than it does yield. And those models continue to work. Yes. And they work better internationally than they do domestically. Again, we're talking about annual earnings, not the quarterly earnings. But Latney was brilliant. He taught me an awful lot about inefficient markets.
Yeah, well, before you go there, I find that work fascinating because most people focus on the last 4 quarters and they want to see sequential growth quarter over quarter or even year. The last 3 to 5 years, they look backwards instead of looking forwards. What you're doing that's different, if I understand you correctly, John, and I just want to recap it for the audience, is that you're looking forward, in other words, to the right of the chart, so to speak, and looking out fiscal year 1 year ahead and then 2 years ahead, and then you want to see what those earnings expectations are, and then you're looking to buy stocks that are able to beat or that you believe will be able to beat those analyst expectations for 1 or 2 years in the future. Is that correct?
That's correct. And then, that's absolutely correct.
And then your other point that you made, which is also brilliant, is that you're saying look internationally because there's a lot more ability to capture that alpha, so to speak, in the international markets, non-U.S. Is that why? Why? Because you have less eyeballs looking at those stocks?
That is held to be the case.
Okay.
However, if you look at the number of analysts, that's not always the case, because I'll tell you why. The international market is just less efficient.
Understood.
You still have a large number of analysts in the international market. You even have a large number of analysts in the emerging markets, and yet our excess returns are highest in emerging markets than they are in other markets. In other words, let me give you a risk return spectrum, if you would.
Sure.
The most efficient market is, of course, the Russell 1000.
Okay.
CTEF, our analyst revisions variable that we have, our equally weighted 6-factor model, which I published in 1997, continues to work. The CTEF model works well in the Russell 1000. It works better in the Russell 3000. When I go to the MSCI non-US, it works even better.
Oh, wow.
In the MSCI ex-US. When I go to MSCI global, yes, it works well. And if I had a nickel, and if I wanted to invest my last nickel and make excess returns, I would go to the emerging markets, where our analyst forecasting variable is just, well, it's not like the light on the road to Damascus, but it's highly statistically significant.
Understood.
And your T values that go from 3 in the U.S. go to about 5 or 6 in the emerging markets. And your first thought is, Lord, just give me a little bit more of that.
Wow. Yeah, it's almost double. Wow. So, John, so I understand your investment strategy. And then you're quant based. So what you were able to do was you took a lot of the academic research, if I understand properly, and then you quantified it, so to speak, and came up with models where you're looking for certain criteria. And then if the stocks meet those criteria, you'll go ahead and buy them. Is that correct?
That's exactly right.
So the next question for you, John, is how do you handle risk, and what mistakes do you see people make with respect to risk management?
Oh, that is really the question that we're going to discuss today. Here's the thing. Suppose I told you that I'm an old school finance person, that I believe in Markowitz efficient frontiers.
Okay.
I will tell you, in my honest opinion, Boy Scouts honor, and I was an Eagle Scout, Boy Scouts honor, the 1959 Markowitz mean variance efficient model is a very difficult model to beat. A very difficult model to meet. If you want a benchmark, I will give you what we refer to as the MV-M59. That stands for the Markowitz 1959 book. Mean variance efficient frontier, and let's see you beat it. Now, we can beat it. We can beat it if we go to a Markowitz mean variance tracking error at risk framework, where we minimize the expected underperformance of an index for the next year. And so we have worked with our risk vendors to be able to come up with to be able to create portfolios where we minimize our expected underperformance for the coming year.
Okay.
We still like very aggressive portfolios.
So define that for me,
always
John.
say that we want our portfolios to have tracking errors of 4 to 8%.
So can you define that, please? What do you consider?
Go ahead. I'm sorry.
No, it's okay. What do you consider an aggressive portfolio?
I consider an aggressive portfolio anything between 6 and 9%
of a decline. In other words, if it falls 9%.
Pardon me?
How you define that 9%?
A tracking error of 9%, yes.
Okay,
6 to 9%.
Okay.
Annualized tracking error, 6 to 9%.
Okay.
I have never had much respect or use for index huggers.
Understood.
And I refer to these as the 3 to 4% tracking error people, unless they have $500 billion. And then you say, well, we'll let them into the party then.
Understood. Okay,
so in our mind, risk control has to do with, can you take a model that is very good in terms of stock selection and turn it into a optimized portfolio for your clients? And we have 3 levels of testing at McKinley where we do this. We look at the information coefficients, our ICs, which is a level 1 test.
Okay.
And when we look at these, we look at our ICs in the Russell 1, the Russell 3, the XUS, the global, and the EM space. And we see that linear progression in terms of our T statistics going from 3 to like 6.
Okay.
And the reason that we are 90% non-US and global in our AUM is because of the fact that's where our T statistics are higher.
Right.
as they used to say on a commercial, you cannot fool Mother Nature. Well, the reason that we believe our assets are allocated in this form is because that's where our models work best.
Right.
Everybody will go to where they hear the clink of the shekels.
Yes.
That's what people want in life. They want excess returns, and I think they're willing to bear those excess returns as long as the information coefficients and the Sharpe ratios are high enough to show that their return has been that their return compensates for their risk.
No, understood, 100%. They used to say back in the day, why do people rob banks? That's where the money is, right? So
exactly,
you're going after these emerging markets or international plays, so to speak, because that's where the money is. I fully get it. So that's a great way of wording it. So just let me recap for the audience. You look at the tracking error, the T errors in your parlance, and that's a difference between the expected returns of the benchmark and your actual returns in the portfolio or in any given strategy. And then what you do is if you say, okay, we want to be a little bit aggressive here, you would take, that's a question. Actually, let me ask you that question. Would you rebalance the portfolio based on the risk, or would you wait to see how the actual performance is and then rebalance?
No, here's what we do. Here's what we've always done at McKinley. We've always believed that we believe that our portfolio should turn over approximately 100% a year.
Okay.
Which, by the way, is very conservative for a quant strategy. You know, lots of people want to turn over, if they're a global growth specialist, 300 to 500% a year. We have 100% turnover on most of our products in most years, and so that's 8% a month. Now, what we believe, what we have always tried to believe and implement, is that the most important thing about being a quant is that you're consistent. That you're absolutely consistent. And what we try to do is we say, all right, every month we want to have a monthly rebalance.
Right.
We want to have a monthly rebalance of 8%. Now, to be honest with you, our emerging market portfolio traditionally has had a little bit higher turnover. And do we care? No, because that's where the excess returns are.
Right.
Cha-ching, cha-ching, cha-ching. That's what we're interested in our life. We want to be able to produce an IR and a Sharpe ratio. And keep in mind, at Mckinley Capital, we believe that everything in life is determined by Sharpe ratios, information ratios, and the ratios of excess return to portfolio risk. We believe we are very risk conscious. We are the ultimate risk conscious people.
So the way you handle risk, I guess, would be by making sure you diversify the portfolio and you have proper, I guess, metrics or rules in place. If the market goes against you, or if it's a bear market, or you get into a situation where you're just wrong, do you sell it? You use stops to exit, or do you wait for the fundamentals to change, or what criteria do you use to get out of your positions?
Here's the way we've traditionally operated. At McKinley, first of all, we're never going to, we know this. We know that we're not going to be able to time the market probably any better than anyone else.
Okay.
Everybody would always love to have turnover of 150% when their models are engaged, and turnover of 40% when their models are not engaged, and they always want to win.
Right.
And we understand that. We understand that. And as we believe we're reasonably intelligent, and we work very hard. Having said that, we have never found anybody, or very few people, that we look at that we say, wow, these people really know how to not only produce great stock selection modeling and have wonderful risk control, but also can forecast the changes in the market. We've yet to see that trifecta.
Okay, I see what you're saying. So you don't look at the time of the market at all. You're just looking at the stocks and making sure that the variables that you use are still in place. In other words, you want to see the stocks with strong earnings and all that fun stuff.
We want our models to be statistically significant.
Understood. And then you have a price momentum strategy. You said the trend is your friend earlier in the conversation. How would you? Well, actually, before I ask you that question, how do you go about with the trend is your friend? You incorporating that is that an overlay on top of the actual stocks? Because what if you're in a downtrend for the market, but the individual stocks you own are still fine?
Let me tell you how it works.
Sure.
We have what we believe is a quote unquote composite type of strategy. We refer to it as McKinley Quant. Okay. It's our MQ score. MQ score is a score that's made up of primarily three factors. Our forecasted earnings acceleration model, our CTEF that we've published and talk about.
Okay.
And we in our price momentum model, which most times tends to be more of a medium-term type price momentum strategy.
Okay.
And then the standard deviation.
Okay.
Now, we have this MQ strategy that we developed in 2006. I came in August of 2005. We had this strategy that we put together in 2006, Rob Gilliman and myself and me. And we built this strategy because we wanted to have a strategy where we could rank stocks on the basis of information coefficients, use that as a tilt variable to create Markowitz mean variance efficient frontiers. And then our third level of testing, our second level of testing is efficient frontiers. Our third level of testing is a data mining test, where we use a test that Markowitz developed with Ganlin and Hsu in 1994. And they had this test where they said is your model that you're using statistically different from the average of the models you could have used in these different universes?
Understood.
And Harry developed this data mining test. Just another quick story.
Yeah.
The first year I worked for Harry, I joined Harry when Drexel Burnham declared bankruptcy. I worked with him at Daiwa Securities.
Okay.
And I'd been working with Harry for about 6 months. Harry's off teaching mathematics at the University of Tokyo. And lo and behold, we get a call that Harry Markowitz has won the Nobel Prize in economics.
Wow.
Holy cow.
Wow.
So, and so I call my wife. I said, Harry won the Nobel Prize. Now, I had told my wife when I interviewed with Harry on a Saturday morning at Grand Central Station in the Oyster Bar,
Wow.
I told my wife, I said, Markowitz is brilliant. And she says, oh, my God, Harry won the Nobel Prize. I said, well, I told you he was brilliant. She said, yeah, but you didn't tell me he was that brilliant. I said, okay, guilty as charged. So Markowitz wins the Nobel Prize. Okay, we then start a fund because we're working for Daiwa Securities. We're giving a seminar in Tokyo, and they said we're going to start this fund. Our fund did very well. In the early to mid 1990s.
Okay.
All right, Markowitz is brilliant. Continues to be brilliant. He's a spry 92-year-old now.
Right.
At the time he won the Nobel Prize, he was the chaired professor at Baruch College at City University of New York.
Right.
And I think he was about 62 or so.
Okay.
And so Harry was kind of like he's kind of like your friendly grandfather.
Right.
He's brilliant. And if you think he's smart, he will surprise you by how brilliant he is. Oh. When they tried to teach us Japanese, Harry could learn Japanese. I couldn't hear the difference between and
Right,
Harry
right.
said, oh yeah.
Understood.
But anyway, so we worked with Harry. The first year, our portfolio was up 3%. The market was down 4%. So we had a 700 basis alpha.
Right.
Harry walks in, and I'm from Atlanta. We're celebrating the first year. I'm kind of whistling Dixie in the background. And Harry says, who in the hell is whistling it? And I said, that's me. And he says, why? I said, well, we're happy. We've won. For the first year, we want to win. We believe we can win in 3 out of 4 years.
Right.
And Harry says, well, did we get lucky? Now, where I come from, I have to keep it clean. We have different definitions of getting lucky.
Sure.
And so I kind of smiled, and Harry says, with respect to portfolio theory, John.
Right.
And so Harry turns to Gan Lin, who is our mathematician, who's a Ph.D. in applied math from Carnegie Mellon. And he says, Gan Lin, did we get lucky? He says, I don't know. He says, well, don't you think we should have a standard for measuring how lucky we were? And he says, Ganlin, I want you to go in your office. I don't want you to come out until you develop a model that says our model is statistically significant and different from all other models.
Oh, wow.
And so Ganlin goes into his office, as I kind of jokingly said. Ganlin went into his office for 6 weeks, and we didn't hear from Ganlin. Didn't see Ganlin.
That's funny.
About after 6 weeks, he taps on my door. He says, John, I need data. I said, yes. And he told me, and I gave him data. 2 days later, he taps on the door and says, John, you win. You are statistically significant.
Oh, wow.
And so that became the Markowitz-Hsu paper on data mining corrections from the Journal of Portfolio Management, 1994.
Wow.
We use that paper every day at McKinley. Why? Because we want to make sure our models are statistically significant. See, everybody talks about data mining, and everybody says, "Oh, we're doing data mining. Isn't that the greatest thing you've ever heard?" And when Harry hears this, Harry kind of looks at Ganlin and smirks and says, "We were there 15 to 20 years before most folks even knew the term existed."
Understood.
And so we use that all the time, and it's a very important concept because you want to know. Here's the thing: not only are you statistically significant, but the test also tells you how much of your excess return that you've realized in the past should be expected to go forward. Right. And it's about 59.44% from what we had in 1991, and it's still around 60%. So, in the olden days, when you would make a presentation to a client, what did they do? They took your excess return and they tore it in half.
Right.
The first time a client looked at our back test and said, "We're going to tear that excess return in half," and Harry looked at him and said, "Well, why?" He said, "Because we always tear them in half." And Harry said, "Well, don't you have a more intelligent reason than that?"
That's funny.
And that's how the data mining corrections test developed.
Understood. And just to educate the audience a little bit about the back testing and data mining and everything you're just speaking about, it's very easy to fudge the numbers, so to speak, and come up with statistical anomalies or have a back test be favorable, but in real time it doesn't actually correlate with what the quote unquote back test showed. And that's kind of what you're pointing at here. Is that correct?
Exactly.
Yeah.
I will tell you this. What I was very proud of in 1994, we started our fund in 1991. By 1994, if you put our 3 years of real-time and simulated portfolio on top of each other, they would be almost virtually identical.
Which is the ideal goal of any.
And that's exactly what you're supposed to do.
Right, exactly.
You're supposed to be. When I worked for Markowitz, we ran a pure black box.
Got it.
We ran a pure black box, and lots of people like black boxes. Lots of people don't like black boxes. But I can tell you this: if you looked at our realized portfolio and our predicted portfolio returns, they were very, very similar. Always been very proud of that, and so that's how Markowitz. That's how we started our modeling. And in October, Harry and I gave a paper at the Q Group, the same group that funded me in 1985. And what we did was we said, this is what we believed in 1991. This is what we augmented with our beliefs in 1997 to take into account our forecasted earnings and our further enhancements with price momentum in 2010. And this is what we believe now in our models that we said were statistically significant in 1993 continue to be statistically significant in 2019, 25 years post-publication. They're still statistically significant. They're statistically significant in Japan in Russell 1, which were the universes we were working on in 1991 to 1993. And lo and behold, my gracious, if you take these models and you go to non-U.S. and you go to emerging markets, holy cow, it's even better.
That's awesome. Yeah, that's really, really good. So, John, let me ask you a question here. So, for the average listener, how do you recommend people would handle risk? Just to wrap up this question here, what should they do?
Well, there's several ways to do this. There's several ways to look at risk. If I were, it depends upon how much you have in your portfolio. Suppose I tell you that I believe you should have a diversified portfolio.
Okay.
And suppose I tell you that I wanted to be an institutional type of client or run an institutional style portfolio where I have somewhere between 50 and 75 stocks.
Right.
If I'm doing that, I'm going to put my MQ into an optimization system. I am going to run a Markowitz mean variance efficient frontier, whether I use a full historic covariance matrix like Harry did in 1993, or whether we use factors a la John Blinn and APT, or the Axioma factors, which is what we currently do at McKinley, where we look at statistical and fundamentally based risk models. We have always found in our risk modeling that the statistical models beat the fundamental factors. That's what we found with our global growth variables. But, we believe in optimized, diversified, efficient portfolios. That's how we handle our risk analyses.
So for the audience, they should just help diversify the portfolio and make sure that they have some way of statistically checking to make sure that their actual strategy makes sense and it works in the long enough period.
Yes. Now, see, the thing that's important about it too is the fact if I am an individual investor, and Markowitz and I wrote a paper last year. We published a paper for the Financial Planning Review, which is a journal edited at the Wharton School, and it's for financial planners. The audience are certified financial planners, the 84,000 CFPs in the U.S. We wrote what we refer to as a King's English paper.
Okay.
We always refer to King's English because Georgia, where I grew up, was the last of the colonies. We were the youngest colony. And so we have never acknowledged the Queen of England, but we do acknowledge that we had George III in 1775 when we declared our independence, 1776. So we refer to it as the King's English in Georgia. And what we believe, we wrote a paper where we said, here is our methodology. We wrote it for CFPs because we believe that CFPs are the people that can, for many individual accounts, actually implement this type of strategy.
Understood.
And that's what we believe. And, we go into a risk-return trade-off. We target either a lambda of 200 in an APT setting, or we target a 6 to 7%, 8% tracking error in an axioma system. Some of my best friends are index huggers. We're always taught to say that. Some of our best friends are index huggers, the 3 or 4% type folk. Right. And that's great for them, but it's not I can show you risk return trade-offs that say over a 20-year period. I'm perfectly happy to have a 6 to 8% portfolio as opposed to a 3% portfolio, and that's just the way life is. Now, I will tell you this, my boss often tells me, well, John, you believe in the long run, the very long run, and in the long run, as Keynes told us, we're all dead.
Right.
True. That's absolutely true. But I have never believed, and Latine was big on this. Latine always taught us the people that are looking at quarterly earnings need to look at quarterly earnings over a 20-year period. There's nothing worse than somebody looking at a quarterly earnings, making one decision and thinking that their life is, that they have now found, the ultimate portfolio theory. There's short-term and long-term, and for the most part, we believe that, if you're a rational, intelligent investor, you probably have a 3 to 5 year planning horizon.
Yeah, understood. And that's a really good point, because a lot of the whole smart money circle, the point of the show, a lot of people, whether they're fundamental, they're discretionary, they're systematic, or it doesn't matter, a lot of them just emphasize the point of the importance of looking at the forest and not just the trees.
Exactly.
Yeah. So, okay, next, that's a good segue to my next question. John, what are some timeless lessons you've learned along the way that you'd like to share with the audience?
Well, I will tell you one, the most important lesson I've learned. We were getting ready to launch a Japan equity fund in 1993. And Harry was interviewed at her street.
Okay.
Unfortunately, he was interviewed during the registration period of our fund.
Okay.
That tends not to go over very well with the SEC.
You can't speak, right?
Correct. However, Harry said one line in that Heard on the Street column that was in the Wall Street Journal that is the greatest line I have ever heard for portfolio management. And Harry's line was the following. We have done rigorous back testing on using transactions costs and looking at the risk-return trade-off. And we believe that we will win in 82% of the years, and by a highly statistically significant amount. That what you have to have more than anything else, you have to have intelligence and belief and patience.
Interesting.
And as he says, if 82% of the time winning is not good enough for you, and if our excess returns of 300 to 500 basis points are not good enough, take your money and go elsewhere. because I don't need to have my life be made miserable by a client with outrageous expectations.
So intelligence, belief, and patience. Those are the three magic principles.
Exactly.
Yeah, I love it.
Exactly.
I love it.
And Harry was exactly right. Now, of course, that there's subtle ways to say it. Harry was more subtle than I would have been, obviously. But the thing that's most important is when you have a quant model that works, you have to realize it's not going to work all the time. And the biggest error you can make, the biggest error I have ever seen on Wall Street is when folks say, what's working for me today?
Yeah, style drift, right? When they change your style.
I mean, you just want to. There are times in life when you have to say, "Are you kidding me?"
Right.
If you can win in 4 out of 5 years, there are times when I kind of joke some of our colleagues where I say, sometimes you just need to shut up and invest.
Yeah, it's serious. John, not even this with quants. It's also with discretionary. There's no system that works every single year, guaranteed and 100% returns.
Correct. The biggest problem you can do is abandon a quant strategy at the low point, because invariably you're going to always drop it when it comes back flying high, and then all of a sudden you look at it and you say, well, I missed I got out and missed the upside, and damn, I still got stuck with the downside.
But isn't that the same for any other strategy, for fundamentals or for discretionary or for anything at all, technicals, whatever?
Well, the thing that, yes, but here's the thing about it: whether you're systematic, whether you're fundamental, whether you're a quant per se, and the difference between a quant and a systematic is very semantics based.
Right.
But from my perspective, the way I view it is the following. If I'm an investor for my own personal portfolios, I invest for anywhere from 3 years to 30 years.
Right.
And sometimes, you sit there and you say, can I afford the underperformance of a stock? And the answer is yes. I have a stock that I've owned for 35 years. Why do I own it for 35 years? Because it's outperformed the beta. It's outperformed the market with a beta of 0.25, and it has a 4% dividend yield.
Yeah, why sell it? Understood.
And so why am I going to sell that?
Right.
I mean, eventually I will eventually sell it, but, in my mind, I'd rather leave it for my kids and let them fight over it.
Right. So, John, I guess the next question: what are some timeless mistakes you see people make?
One of the biggest mistake is that they reach a point where they say, I can't afford to keep my investment strategy going as I originally conceived it. There's a big difference between knowing, in other words, factors come and go. We know that.
Right.
And in the paper that Harry and I wrote, one of the side issues was, how long do paradigms last?
Okay.
How long do paradigms last? And we've shown that, 75% of our paradigms have lasted for over 25 years.
Oh, wow.
Which is remarkable.
Yeah.
Now, they don't always work. Am I going to throw out a variable that's worked in 80% of the years because it's failed the last 2 years?
You can't make it.
I would not. Now, some of these young whippersnappers are going to say, well, it's not working. Well, you know what? I don't think you're smart enough to come up with a better variable that's going to win 80% of the time and do it right when mine has failed. So if you think you can, be my guest and go ahead, but I'll take odds on that for the next 10 years.
Right, for sure. So that makes good sense. So it's avoid style drift, stay with the style, and make sure it works. And if you have,
well, you always have to enhance models. I'm not a fool. You have to enhance models. And I'll tell you one other thing. My boss, Rob Gillum, our CEO, CIO, is always concerned with making sure that we're testing all the right new variables, alternative data. And he's exactly right. But here's the problem with alternative data. Everybody wants to test alternative data. And I guarantee you that we've tested over 20 databases, new databases, and 18 of them have ended up on the cutting room floor, as they would say in the world of making film. 80% of them are on the floor. And so there may be 2 or 3 that you find out of 20 that are worth looking at.
Yeah, no, for sure. It makes perfect sense.
And see, you have to test them because your clients are always saying, "What are you testing? What are you doing for me now? What are your research agendas?"
Right, of course. Especially
And so we test them. But the thing about a lot of these new databases is they're very specific to a sector or two. And if you're a diversified portfolio manager, we every Tuesday night we pull down data on 45,455 stocks, approximately,
all over the world.
Every Tuesday night.
Right.
Now, we take into account liquidity conditions. And after we take into account liquidity conditions and we have our number of analysts that we need to have, 2 analysts, we end up with a universe that's a very liquid universe of approximately 4,000 to 5,000 stocks globally every week. And those are the stocks that our portfolio managers memorize the statistics on those. I'm being facetious when I say that.
Understood.
But our portfolio managers are responsible for knowing as much as they can on those stocks. And so that's how we do it. We believe that you pull down data on 45,000 stocks and you try to know as much as you can. And if alternative data will help you with that, then we're all in. We've been using neural network programming to take into account transcripts on earnings work and different sentiment value, and those do enhance. But I will tell you, they enhance at the margin. It's not like they're going to add more than about 15% to your current alpha.
Right.
It's not like the light on the road to Damascus where you go, your excess return was 300 basis points, and now you've got an extra 300 to 500 basis points. Holy cow, let's break out the Grey Poupon. No. If you're 300 to 500 basis points, you're going to pick up an extra 15. You're going to pick up an extra 30 to 50 basis points. Are you willing to do that? Yes, you are.
Yeah, for sure.
However, one of the things that people get excited about is they want to test all these alternative databases, and they find out the cost of the alternative database. And you better make sure that it increases your basis point by about 15%, because otherwise these databases are not cheap.
Yeah, for sure. No question.
You look at them and you go, holy cow. One last thing too, and that is, when we do our data mining corrections modeling, we take into account a stock selection model where we use an equally weighted framework. Well, not an equally weighted framework, pardon me. We use a static weighted framework is what I meant to say. We use a static weighted framework at Mckinley for our model. We have a public model that we use that we tell everybody about. In other words, we have a proprietary system that we use. We have a public model that we describe. And our public model has all the factor exposures of our private model, but we just have something that we can talk about this. Right. We started this framework when I was working for Harry. We had a proprietary versus a public framework. When we talk about our public framework, I think it's interesting, a paper that Harry and Galen and I just have published in Annals of Operations Research. We published a paper where we said, all right, everybody believes in all this new machine learning technology. Everybody not only wants to do alternative data, but they want to do machine learning modeling, and they want to do least angle regression, LAR, and they want to do lasso regression. They want to do neural networks. And if you do all this work that you're doing, you're going to compare that to our robust regression, where we take into account outliers and we look at multicollinearity. Well, if you take into account the models that we were using, the Beaton-Tukey procedure from Sir John Tukey at Princeton in 1974, augmented by what he's doing what he just published in 2000 as his updated model, what you find is our models do every bit as well as the LAR and the lasso modeling. So all these new techniques give you answers very, very similar to what we did. It's always nice to say, you know what, this is what we believed in 1993. If we were going to use the new technology, which is what we used in our paper we published in 2019 in the Annals of Operations Research, we find that we get a very similar answer. Our answers are not statistically different.
Yeah, that's the whole idea, right? Where it's time tested and it just works.
Exactly. You want it to work, and you do test the new technologies because you have different benchmarks.
Yeah,
it's kind of like if I'm going to run a benchmark, I'm going to run it up against Markowitz mean variance efficient. I'm going to use my outlier regressions, and let's see you beat it.
So
if you beat it, we'll congratulate you, and if we don't beat it, we'll just throw you on the junk pile with the rest of the world.
Yeah, exactly. There's no ego. It's just the best idea wins, right? Everyone's looking for the best idea. It's that simple.
Exactly.
So, John, next question for you is, what's the best piece of advice you'd like to share with the audience?
The best piece of advice is the following. I believe that markets are relatively efficient, but there are inefficiencies that can be exploited.
Okay.
Let me be a little bit less, less vague than that. Let me be a little bit more specific. We believe that there are anomalies that can produce excess returns. We believe that our work in forecasting earnings, our accelerated earnings forecasting model works. Our forecast earnings acceleration model works. We believe that our price momentum model, which has a very low correlation with that, around 0.3, works. The low standard deviation works when the world is going to hell in a handbasket. Those three factors have very low correlations, and they work very well together. And they work better internationally than they do domestically, like we've said. But as you start to look at these models and these factors, what you have to realize is that you are building a model for a 3 to 5 year period, and over that 3 to 5 year period, you're probably going to lose in 1 year, and you may well lose relatively poorly. You may perform poorly. You may get whooped, as they say down home.
Right.
And it's important, even when you get whooped, to realize that if you win in 3.5 to 4 years out of a 5 year period, sometimes you need to have patience and say, well, I guess this was not my year. There's always the question when a model stops working. We're not so naive as to believe that models are going to work forever.
Right.
However, if I show you a 20-year post period and the model works in 16 out of the 25 years post publication, that's pretty good. Most people would say, I'll take that in a heartbeat, and you're getting the excess returns you want. Sometimes you just need to say, well, I guess I can outweight you.
Yeah, exactly.
And you have to have clients that you educate your clients enough to say, you know what, if you think you're going to jump out of this and get to a better model at the right time, at the perfect moment, good luck.
Yeah, it's funny.
Good luck.
I have a book coming out, John. It's called Psychological Analysis. It's a third school of thought in addition to fundamental and technical analysis that I came up with for markets. And one of my concepts in the book is time arbitrage. And it's to that exact point where you want to just be able to use time on your side. Everyone's so focused on the last tick or the last few minutes or the last quarter, where if you have a longer term outlook, you can really clean up. And I love what you're saying here. So in closing, John, I just want to thank you so much for coming on the show. It's been fantastic.
Oh, it's been my pleasure. Thank you for having me.
Really,
it's
really
been
fun.
A real thrill.
Excellent. Well, thank you so much, John. And before you go,
very good. Thank you for your time, and we look forward to working with you. Thanks so much.
Thank you, John. Take care. Bye-bye.
Thanks, Adam.